the probability of success from Series B is much higher than the market average. And so in some ways, you can think of what we're doing as it's like a smart beta product for venture capital. In terms of the algorithm itself, it's actually a negative algorithm. What that means is that we're very good at eliminating zeros. And when you do that, the portfolio kind of takes care of itself. The best pre-seed and seed investors are actually very good at reading people. That's kind of your core skill set. And then Series B investors are different animals in that they are better at reading how to scale up companies.
Welcome back to the Ignite podcast. Today, we're thrilled to have Rob Hodgkinson on the mic. He's the managing director and co-founder of SignalRank, a data-driven venture platform that ranks and invests in the world's top 5% of Series B rounds through pro rata financing. Very cool. His career spans investment banking, growth equity, and startups with a track record that includes roles at, he has an MBA from INSEAD and a history degree from Cambridge. Very cool. I was a history major as well. He's a fascinating blend of operator and quant-driven investor. Thanks for coming on.
Thanks for having me, Brian. Delighted to be here.
So glad to finally sit down with you. I'd love to get your backstory. What's your origin story?
Sure. I mean, as you probably hear, I'm British.
Is that the accent? It's British?
That's the accent, yeah. And I've been in the States for about 5 years. Moved during kind of COVID. But as you said, I'm really a history major at Cambridge. And then I kind of fell in love with venture capital in 2005. And so I've kind of been pursuing this path for the last kind of 20 years on and off through kind of meandering. And
yeah, so how did studying history at Cambridge lead into VC? What's that story?
So I studied a lot of like post-colonial African history at Cambridge. I was kind of intrigued as to why African economies didn't take off in the same way they did in the West, and particularly the role of kind of SMEs as a major contributor in the economy. And so in 2005, I actually did an internship with the African Venture Capital Association, where they asked me to create effectively a pamphlet on what was happening within venture capital within Africa. So it's basically a list of, it's kind of a proto print-based version of Crunchbase on what was happening in the ecosystem there. And I kind of fell in love with this idea that with a small amount of capital, you can actually build a meaningful business, and that actually as a VC, as an investor, you can help support those kind of founders along the journey and be a very small part of that journey. And the advice given to me at the time was, look, you're a history major, no one's going to believe you can count. So go and join a bank, work for a bank, do an MBA, and then you can probably get into venture capital. And broadly, I thought that was good advice. And so that's kind of the career path that I followed. And so I joined Rothschild in 2007 on the investment banking side, and then went on to do my MBA at INSEAD.
Amazing. Yeah, great school. And, what did you take away from those early years that, still shape how you evaluate risk and capital efficiency today that try to figure out the top 5%?
Well, I think it's more it's the same as everything, really. It's really the people you're backing. And, technical kind of banking skills are useful, but at the end of the day, it comes down to the people you're backing and their skill set and actually kind of founding and scaling businesses. Even though we are a quant-driven platform at SignalRank, there is kind of this delicious irony that we're a quant-driven platform, but really it's built on kind of the reputation and credibility of individuals and humans as investors.
Yeah. So let's just dive right into what the thesis is, what's the backstory there? How did you come to do this? And this is a very particular niche, right? It's Series B quant-driven financing. So tell us more about that.
So I mean, as you said, I was at Berengier, a VC fund in the UK, and I left to join a portfolio company called TVPlayer in the media space. And it took us a year to raise our Series B, and ultimately that capital. So as a UK business, we're building kind of the equivalent of Hulu in the UK. It took us a year to raise that Series B, and ultimately that money came from the US. And so I left that business and I moved to the US in 2020 and thought that, that Series B gap in Europe was kind of interesting.
Yeah, I've experienced this as an early stage investor, right? You can get the pre-seed, seed, and A done, but once you kind of go B, you kind of have to Delaware C-Corp it and go to USVC. Why is that?
Well, that's a slightly different question. I think the more and more you are seeing European founders kind of accelerate their move to the US. Our business, the TVPlayer, was very much a kind of localized play in terms of, the content and the audience was very much UK based. And so we were never thinking about moving to the US, but you are seeing kind of what you're talking about is kind of the Delaware flip and founding teams and sales teams moving to the US. And that is happening more and more. Investors are actually encouraging founders to move earlier, even though the capital ecosystem is much stronger in Europe now than it was 5-10 years ago. And so the problem that I experienced is actually less of a problem today. My kind of hunch in 2020 was that there were these great companies in Europe, that there could be an interesting way being sat in the US of helping US investors get access to these European companies. And so I did 3 or 4 kind of deal by deal SPVs, helping family offices access these companies. And I could see that this idea of kind of accessing these companies at Series B, where I really worked with seed partners who were in these companies but had just run out of money to continue to finance their pro rata. And so I basically offered to finance these seed partners pro rata on a kind of deal by deal basis with capital coming from these family offices. And I could see that it was really a problem and really an access point where you could reduce adverse selection, and it was actually pretty scalable. But the problem with my structure with the deal by deal SPVs is that, as you know, each SPV is like herding cats. And so I was introduced through a mutual friend to a co-founder at SignalRank, Keith Tier, he's been an entrepreneur for 4 decades. He also happens to be a Brit, also happens to be in Silicon Valley. And he had also kind of tested this idea of providing pro rata capital to seed investors. And when he was the chairman of a fund backed by a British pension fund called Legal & General. And so he'd started to build out some algorithms to identify the top 5% of Series Bs. And I had a network of seed managers who I could see had this issue around kind of pro rata financing. And so I joined Keith and the rest of the team in 2021. And so we've been building this for the last 4 years.
Yeah, that's really fascinating. And it is a problem for us early stage investors, right? We pre-seed and seed funds. For someone like us, we write such small checks that typically our pro rata expires in the Series A conversion, right? We don't hit the major investor thresholds. I guess I could use a side letter to try to kind of wiggle my way in, but like typically I see 250 to 500K is the major investor threshold in like a Series A conversion. And as you get it later, right, into the Series B, you could probably speak more to this than I can. The checks get larger to maintain that pro rata, and it gets harder and harder.
Yeah, I mean, we always talk about how there are basically 2 types of pro rata. There's legal pro rata, where it's documented in the investment documents, and then there's relationship pro rata, where even if you legally don't have the right to continue financing that company, because seed investors and pre-seed investors provided the capital much earlier in a company's journey, when the risk was much higher, they tend to have a much better relationship with founders than kind of later stage investors. And so even if you legally don't have the right to continue financing, if you as a seed investor turn up at the Series B and say, actually, I do want to do my pro rata, in most cases, the entrepreneur will not only let you do that, but will actually be delighted that you'll be continuing to participate and continue to support that company at the Series B. Assuming you have been a helpful investor, then they actually want you to continue to be engaged with the company.
That's why I never get the Series B pro rata. No, I'm joking. So yeah, these rounds are typically anywhere from 10 to 20 million, you'd say, on a Series B?
No, well, so the median Series B across the whole ecosystem is probably $25 million.
Okay.
Kind of globally.
Yeah.
They're roughly 1,500 to 2,000 Series Bs a year globally. And our algorithm is, and we can get into how it works, but essentially we're picking the top 5% of Series Bs. And the average Series B there is about 50 million, 50. Although in this kind of age of AI, that round size is actually creeping up. And so if you look at Series Bs backed by kind of the 4 venture majors of Lightspeed, Andreessen, General Catalyst, and Sequoia, the average is more like $75 million. And so even at Series B, the round sizes can get pretty chunky.
Yeah, and so you named some tier 1 VCs there. How much of the round do they typically take, and how much is remaining for the other investors?
Yeah, it's good questions. We've seen the number of participants in these in rounds backed by those tier one investors actually double, which is a little surprising, right? The amount of capital raised by those four funds I mentioned has increased a lot. Even they cannot finance 100% of these 75 or $100 million rounds. And so the number of participants has gone from on average 3 to 6 in these kind of larger rounds. And that means for our model that the number of access points has actually increased. And so somewhat counterintuitively, our access has actually improved considerably, such that we're pretty confident that we're now getting access to some of the best Series Bs globally with our model.
Yeah, and let's get into how the model works. What are some insights on, you talked about round size. The median is actually 25, but in the top 5%, it's more like 50 or 75. What else are you like? What is your model looking at? Is it a momentum based, or like what are the kind of the factors of the model?
Yeah, we exclusively look at who's invested and how, and so we're looking for investor patterns and behaviors. And so we actually don't really look at, or we don't look at the kind of company fundamentals at all. And so there's this analogy in data-driven VC of the horse race, and do you bet on the horse or the jockey? And so do you bet on the market, or do you bet on the kind of entrepreneur? Our insight is that actually you need to look an abstraction higher and look at who the horse trainer is.
Yeah, like who's placing the bets, right? Look at the winning, people who are gambling and winning on these horses, not so much the horses themselves or the
exactly.
The
so our argument is that there's actually very little predictive power in company level data, because unicorns by definition are exceptional. And so the idea that I don't know, hiring cadence, or where the founder went to school, or their kind of social media presence is going to have any predictive power. We don't really buy into that philosophy. Our idea is that because in venture capital there's this notion of persistence, and the best VCs historically are likely to be the best VCs going forward, that actually if you can score and rank VCs, then that actually becomes a pretty powerful model for predicting which companies are going to be the winners in the future. And that's because VCs spend a lot of time kind of brand building and demonstrating they have kind of network centrality, such that when the next Elon Musk or Mark Zuckerberg or whoever it is comes along, then actually the best VCs know that world-class entrepreneurs pick VCs and not the other way around. So when that next entrepreneur comes through the door, you as a VC fund need to, your name and your brand needs to be kind of front and center of that entrepreneur's mind.
That's pretty amazing. Yeah, and I remember when we first chatted, you pulled up your platform and showed me my ranking as a pre-seed investor, which was pretty high. I think I was like 46 in your database. I was like patting myself in the back on the call, which is pretty cool. That means, there's got to be, I don't know how many pre-seed investors there are, probably thousands.
Yeah, thousands. Yeah, exactly.
So to be in the top, 1%, is pretty cool.
There you go. Yeah, I think we take data from Crunchbase and Preqin, and our platform updates every day. And so it's over a kind of rolling period. So it's not actually, it's kind of fresh data every day. And that allows us to kind of rank VCs daily and then look for patterns kind of across those rounds. So our model is actually, we're not just looking at who invested at the B. We want to make sure that you've been backed by world-class investors at the seed and the A and the B. And if you look for that pattern, the probability of success from Series B is much higher than the market average. And so in some ways, you can think of what we're doing as it's like a smart beta product for venture capital. And in terms of the algorithm itself, it's actually a negative algorithm. What that means is that we're very good at eliminating zeros. And when you do that, it's the kind of Howard Marks school of thought at Oaktree that if you eliminate zeros, the portfolio kind of takes care of itself. So when we select a company, we're not saying
this is why I always invest post-launch, post-revenue, because if you have traction, everything else just takes care of itself. But if you don't have traction, what are we even talking about here? Just how great you are and how great your idea is?
Well, the thing is, for our model, we know that you and the best pre-seed and seed investors are actually very good at reading people. That's kind of your core skill set, right? So and then Series B investors are different animals in that they are better at reading how to scale up companies. And so we look for that blend of kind of skill set. So that there's quite an interesting anthropological side to what we're doing, which is that it's this combination of world-class people readers and world-class kind of company readers, and we
Yeah.
love that blend of the two. Because if you just look at Series Bs and ignore the seed and the A, you can actually get into quite a lot of trouble. Some of the biggest frauds over the last 5 years, and I won't name names, but they're names that they all raised fantastic Series B rounds. But actually, if you look at who invested in the seed and the A, they were not kind of reputable seed investors. And so we look for kind of that pattern of being backed by world-class investors across multiple rounds.
Yeah, that completely makes sense. And so you guys are running it's a fund. It's a blind pool of capital now.
We're actually structured as a Delaware C-Corp, so we think of ourselves more as a fintech than a fund. We basically invest from our balance sheet, and it's a permanent capital vehicle where our intention is ultimately to list this as a company with the assets kind of sitting underneath.
That's really interesting. What was the decision-making process in taking that path versus a traditional kind of LP, 10-year fund?
Yeah, we think the biggest problem in venture capital is liquidity. And if you can have a listed vehicle that allows your investors to convert TVPI or MIC into DPI at will, we think that's pretty compelling. And so that's kind of the main motivation behind this structure.
Fascinating. I wonder if I should do that for my next fund, like just flip the LLC to a C Corp. Would it work for someone like me in a pre-seed seed capacity? And then that way I'm kind of creating a holding company almost of assets.
Yeah, it's not for the faint-hearted. And it's taken us, we've been building this for 4 years. We think the logic of what we're doing is kind of hard to escape. Our access point is now working pretty effectively. We partner with about 300 seed managers, seeing in some months up to 70% of all Series Bs globally come across our desk. And then we're investing in 2 to 3 Series Bs a month. So our strategy is to invest in 30 Series Bs a year. And, it's taken us longer than we expected to raise the capital because I think people wanted to see the track record, see that this can work, get comfortable with this structure. I think once you reach, critical mass, there is an inevitability to this idea because every investment that you make increases that diversification and reduces the risk for every investor going forward. Our portfolio is now at 40. And so in the last 2 years, we are probably the second most active Series B investor globally after Andreessen.
That's amazing. What were some of the challenges of doing the C Corp? I mean, other than, it's kind of a first-time fund and you're trying to convince people it's going to work, but what were some of the administrative headaches in running a C Corp kind of holding company in this manner?
Well, it is mainly investor education and then getting the kind of legal rails or framework set up to allow you to do this. I think what's fascinating to us is that since we set this up, we see the whole asset management industry moving in this direction, right? If you look at, Larry Fink's at BlackRock, his chairman letter talks about the democratization of alternatives. Robinhood have just launched Robinhood Ventures with this 1940 Investment Act, like kind of closed-end fund. So, Apollo, Hamilton Lane, and other managers are setting up these kind of liquid, semi-liquid structures to allow retail investors and wealth managers to participate in venture in the private markets. And that trend has really accelerated in the last 2 years. And so we see ourselves as being the kind of spearhead of that trend for venture capital and focused on kind of Series Bs, where for reasons we can get into, we think that Series B is kind of a Goldilocks round that delivers this nice balance of kind of risk and return for our shareholders.
That's really fascinating. Yeah, there's been a lot of evergreen funds created, a lot of these kind of structures from the big asset managers so they can sell to retail investors. A really fascinating take. And then how do you guys make money? You just take a management fee as the company, and you're trying to avoid double taxation as well. You're trying to run it down to zero profits every year too, I would imagine. Or you're probably running a loss at the C Corp.
We don't have management fees. We have an expense ratio set by our board, which includes kind of investor representation. I mean, what we've built here is a model that has huge operational leverage. which is unusual in venture, right? I mean, in venture, typically, if you want to scale your AUM, you need to hire more people. I think Andreessen is at above 500 people now. Whereas in our team, it's kind of, we're a small team, fewer than 10 people. We don't think we'll ever need more than 10 people. So we actually think we can scale down that expense ratio to ultimately our target is to get that to 50 basis points. And then on the kind of management incentive side, our incentive is in the form of equity rather than cash. And we think that actually provides much better long-term alignment with our shareholders because we are incentivized to compound those returns over time rather than kind of monetize through cash and like through carry.
And so the way, if I'm on your cap table as an investor, the way I get liquidity is I do a secondary transaction and sell it to another investor, basically. Until you go public.
Until it's public, that's the case, yes. And then once we're public, the structure is somewhat similar to how Destiny, DXYZ have structured their funds. So it's a internally managed closed-end fund, and that's our structure. So yes, you would, if you wanted liquidity once we're listed, you would sell on the open market.
That's really fascinating. And then what about raising more capital to make more investments? So you do a tender offering to LPs,
Correct.
and current and
at NAV. Yeah, that's right.
At the NAV, which is the net asset value. I'll try to pull out the acronyms because we're both finance guys. So anybody listening understands what we're talking about. Interesting. And so, yeah, you market to market. You probably have an auditor that audits everything and says, okay, this is what it's worth. Here's the last mark on this, or this is impaired, so we should mark it down. And so there's some net asset value that's marked to market at a certain cadence. No, I was going to say, and then you can go raise another $100 million, but then it would, if you raise $100 million, it would dilute everybody's share, right? That's currently on the cap table.
It would, but that capital comes in at your net asset value. So you're increasing that asset value by that $100 million.
Interesting.
So yes, your equity ownership as a percentage goes down, but it doesn't impact the share price for that new capital.
Why do you think the VCs historically took the LP path versus doing the C-Corp path? Because it seems kind of interesting to do the C-Corp path.
It's the GPLP structure is much more tax efficient for investors and LPs who are tax exempt. And so that is a better model for those types of investors. And so those are typically not our shareholders. Our shareholders are family offices, wealth management groups.
Interesting. So like nonprofit foundations like Yale Foundation wouldn't find this structure appetizing because of the taxation of the C-Corp.
That's been our experience today.
Yeah.
And so if you think about what we're selling, it's really kind of access to high quality Silicon Valley assets, because through this systematic approach and through this pro rata model, we are able to invest alongside the best investors in the world without our shareholders being kind of LPs in those funds.
Yeah. What about the really fascinating? Could you have done, I don't even know if this exists, could you have done some sort of kind of a REIT structure, or is that just only for real estate where it's a pass through?
Well, you have the kind of BDC structure, which is kind of somewhat analogous to the REIT. In some ways, this is kind of somewhat akin to that structure. We like this model because it provides flexibility to do what we want to do.
Yeah, that's so fascinating. So you've called speed and access your edge. How do you prove and fund deals in days when traditional funds are taking weeks or months?
Yeah, look, I mean, SignalRank's an unusual investment group in that it's systematic, we're programmatic on entry. And so our diligence process is really about establishing facts and verifying facts. So we do want to look at the term sheet to make sure it's on market terms. We want to look at the financials because the biggest mistake we can make is to back a bridge round that's disguised as the Series B. And then we also look at the cap table because we want to make sure that who we think has invested has indeed invested. So that's the core of the diligence, because we are kind of standing on the shoulders of giants in terms of only investing in companies where a world-class investor has invested at the C, the A, and the B. And because on our model, those are the best investors in the world, we think and that there is a new lead in the Series B. We think, what additional diligence is that are we going to provide that's actually of significant value, given that these world-class investors have have already backed this across 3 different investment committees.
Yeah, so let's imagine we're looking at the cap table and the term sheet and everything looks great. It's your model saying, yep, this is a top 5%er. What are some things that you've seen in term sheets where you guys kind of take a step back and pause and maybe decline to participate?
It could be things like founder secondary. It could be vesting of founder stock starting again, or just kind of egregious liquidation preferences. Some of the things that we look for to make sure that this is a competitive, high quality Series B.
So what have been some of the more surprising findings from ranking thousands of these venture rounds? Are there any repeatable patterns that you've seen that, besides obviously the investors on the cap table, that predict breakout success?
So right now there are essentially 3 sectors that are within that top 5% of Series Bs. It's AI, unsurprisingly, defense, and fintech has come back in a big way. So, we're really not seeing that many consumer-facing companies raise high-quality Series Bs at the moment. And those sectors just continue to represent, I'd say, 80% of the Series Bs that we're seeing.
So for all the VCs out there listening, and I do have some VCs that listen to the podcast, and they're like leaning in, this is like cool. How do I work with you? And I don't have a bunch of cash. Like, what are the terms for VCs listening?
So there are really 2 reasons VCs work with us. And as I said, we have a network of about 300 seed investors now. And the reason that's grown is kind of twofold. One, we offer 20% deal by deal carry. And we offer capital at that level because our whole system is about reducing adverse selection. And we want to make sure that we can see the next kind of power or company within your portfolio, and you're not just sending us deal flow that you couldn't finance elsewhere. And so 20% deal by deal carry. And then secondly, as we talked about already, we're able to move very quickly. And that is really empowering to our seed partners because it gives them confidence that they can go back to the entrepreneur and say, actually, I'm good for my pro rata. You're not having to wait to fundraise an SPV, which, as we know, can take weeks or months.
Absolutely. I've lost deals because of it.
Yeah, so I'd actually say that ability to move quickly in some way, and also to say no quickly, is in some ways more powerful than the carry. So I actually built a software product for those seed partners to share term sheets with us. It turns out that no one actually uses it. Everyone just emails me or texts me when they have a kind of term sheet. No MFNs. Everyone is on exactly the same terms. So everyone is on kind of 20% deal by deal carry. And so I'd just suggest people kind of reach out to me and we can have a conversation about some of the Series Bs that we could potentially help with.
What are the kind of the range of allocations that you look for? What's on the bottom end? What's the smallest check you like to write? And what's kind of the largest?
Yeah, we at scale, we'd like to write 30 Series B checks of $5 million each a year. That's our kind of long-term target. The smallest check we've written to date has been $50K, and the largest check we've written has been $1 million. And I'd say the median is about 300 or 400K. And so that's where we are today. And as we raise more capital and scale what we're doing, then our intention is to kind of scale that check size accordingly.
Given all this, I mean, do you think the whole traditional VC model is breaking down, or is it just kind of evolving into more nooks and crannies of structures?
I certainly don't think it's breaking down. I believe that the early stage of investing will continue to be an artisanal, very human business. And I don't think that's going to change. I think you're going to see more and more of these kind of quant-like strategies and approaches and passive strategies at the later stage. I think that has already accelerated, and I expect that to continue to accelerate. But I think, given the very kind of human element of that early stage investing, I don't see that changing anytime soon.
Makes sense. Yeah, it's hard to be quant-driven in the pre-seed. Very much you are kind of sizing up the opportunity subjectively. And it's something that, and I tell my LPs this, you're paying not for my, spreadsheet abilities, but you're paying for me having looked at tens of thousands of deals over a decade, right?
Yeah.
And just that amount of churn that goes through my mind, how many decks I look at, how many founders I meet, and just that ability, that's what you're really paying for. Versus like a Series B or a late stage, it's much more of a private equity, analytically driven. Can we scale this company? The things we talked about.
Yeah, ultimately, we think that the private markets start to look a lot more like the public markets. In the public markets, the index now beats 90% of active managers. over a 10-year period.
In the private markets.
In the public markets.
Right. Yeah. Yeah.
Yeah.
And I'd say the same is probably true. You've seen the angel list study, right? Where if you invested in every angel list deal, you'd be in the top like quartile of VC.
Exactly. And so we subscribe to that philosophy. The challenge is you can't invest in every angel list deal because
it's 20, 30,000 a year or whatever.
Exactly. So our strategy is to say, well, can you eliminate, the bottom 95%? So that's why we say it's kind of like a smart beta.
Yeah. It's kind of our vision too at Team Ignite. I think we've talked about this is there's 20,000 pre-seed fundings every year. There's 10,000 seed fundings. There's 30,000. That's the universe of what I could look at. And our strategy is at scale to get up to 300 deals of, call it, 500K checks, which is a lot of capital.
Yeah.
500 million, probably $1 billion fund with a bunch of reserves. That's kind of the long-term vision for us because we basically want to see ourselves getting into the top 1% of those stages long-term. It's a good goal, but something to strive for.
Exactly. No, I think even at pre-seed, you are seeing more and more of these kind of exactly very similar strategies to what you're pursuing. Dan Gray and Peter Walker have talked a lot about how diversification has had kind of it's been kind of a negative word in venture, but actually when you look at the data, you're much more likely to outperform the market with a kind of
a spray and pray strategy. Let's just say
Correct.
It, just put it out there.
Correct. Yeah.
But I think what people miss from that is, I say no 99.8% of the time. So how is that spray and pray?
Yeah.
What are you even talking about?
When you look at the public markets, the active managers who can deliver alpha, the Renaissance Technologies of the world, are charging 5 and 44, and so
5% a year.
Yeah.
Wow.
So I don't know, I think you should expect to see the same in the private markets, where we want to be that kind of low cost, high quality, diversified index. But there is totally a role for people who are world class at this and we've done this for a long time to actually charge beyond 2 or 3 and 30.
I've been thinking about this actually as I kind of scale Team Ignite. Do I need to scale 2 and 20? Like if I have $1 billion fund someday, do I need to charge a 2% fee on that to actually go deploy the capital? I don't know if I do, right? So I've been thinking about, the Andreessen decks recently leaked. I think they charge 2.5 and 25.
I think as we talked about before, the challenge with venture is that there's not much operational leverage. And for you to manage $1 billion pre-seed or seed fund, you're going to need to hire a lot of people, just as you said, just to churn through all those decks.
At least 2 more, because I do 100 a year now.
Yeah.
By myself. So I'll have to hire at least 2 more people to do 300 a year.
That's kind of the justification for the 2% management fee, is that it's a high cost business to actually go and source, filter kind of quality opportunities. That's beyond, that's before you get into the notion of, value add and then ultimately exiting those companies too.
How do you structure those carry share mechanics with your LPs in a C-Corp structure?
So we spin up an SPV per investment and it's in the name of our partner. So from the company's perspective, it is our partner financing the Pro Rata. That's not to say that, we obfuscate the fact that we are financing that capital. Ultimately, we are the signatories of that SPV for regulatory reasons. So the company is aware of us and knows that we exist. It's just that both the founders and the VCs prefer if that vehicle is in their name.
Yeah, makes sense. And how do you guys think about exits? And when do you exit a position? Do you wait for a liquidity event or do you do a secondary sale, or how do you think about that?
Yeah, I mean, we're systematic on entry and we would like to be systematic on exit too. And so we have this vision of selling each annual cohort after 5 years. And if you do that, that can then bring capital back onto our balance sheet and then we can reinvest it. So you get this kind of compounding returns over time. And so that's where we would like to get to. Our first vintage was 2023. So we're still 3 years away from that. And the secondary market has developed substantially even the last 5 years. And we expect that to continue. So we're constantly talking to potential secondary buyers about acquiring our annual cohort. So we won't be looking to sell kind of individual positions, but we'll be looking effectively for like a strip sale across each annual cohort.
Interesting. Very fascinating. Well, let's wrap it up with some wrap-up questions. It's not rapid fire, it's wrap up questions. What's one belief about venture investing you've completely changed your mind about in the last 5 years?
I thought that AI, given the productivity gains that AI can deliver to entrepreneurs and teams, I would have thought that would change the way that companies are financed and that we would move away from the kind of alphabet soup of C to A to B to C. The amount of capital that people would raise would change. And what we've seen so far, at least, is that is not the case. And Greylock has this thesis that the old moats are the new moats, meaning, yes, you can have a small team building a product, but you still need a go-to-market strategy. And that go-to-market strategy tends to need human bodies, at least today. So that's one reason why funding hasn't really changed. And then secondly, ultimately, fundraising for the best companies is just a function of supply and demand. So if companies can raise 10, 20, 30 million, or some of these kind of $300 million seed rounds, then they will. So actually, we haven't seen any change so far in the way that companies are funded, and that has been surprising.
That is surprising. And I think I feel like I've seen a lot more traction per dollar raised early on. I'm definitely seeing that, but I think there's kind of a Jevons paradox economically in the ecosystem where, like, if everything gets more efficient, you expect less money raised, less people hired, but the inverse tends to be true. Just more of everything is done. More investment dollars are flowing, more hiring is happening. We just printed a 4% GDP growth. And we're at our, stock market's all-time high. Rates are high. Unemployment's super low. It's a weird time, I think, economically. Pretty frothy out there, actually, especially in the late stage. If you could redesign the venture ecosystem from scratch, what would be the first rule or thing you would change?
This is less relevant for kind of what the part of the market we're at, but I think at a very earliest stage, the notion of investors and advisors charging startups to pitch and to pay for their services, I think is predatory. And
I've never seen that. That sounds crazy.
Well, as I said, I don't think it happens less in Silicon Valley, but outside of Silicon Valley is a practice that happens a fair amount.
Wow. That is predatory. Yeah, I'll listen to your pitch. $100 or $500 or whatever.
Exactly.
Wow. I've seen people sell their time on these platforms, like, hey, meet with such and such person for $1,500. That's
but even kind of egregious advisory shares practice that I think at the earliest stage, I think it's a practice that we try to stamp out.
What is the hardest call you've had to make as an investor?
Well, the beauty of our system is that actually we try to reduce kind of human biases as much as possible. So we have these funny conversations internally where we actually try to, where we'll say, this sector is not a sector that I would personally invest in, but the algorithm has primacy. And so the hard thing for us is actually trying to suppress our kind of human biases and say, well, look, this company's been backed by the best investors in the world 3 times over. They are the best investors in the world on our model. If we don't believe in the algorithm, why no one else will? And so that is a very different way of thinking about investing than most investors.
That totally makes sense. Last question, looking forward for the next 3 to 5 years, what are you excited about?
I'm excited about seeing how this democratization of all scales out and how, we're going to see more of this growth of kind of passive investing in venture. And hopefully, ultimately, that leads to, better returns for our shareholders and for investors in the ecosystem. Hopefully SignalRank can be a meaningful part of that journey.
Where can folks find you?
Yeah, we're at signalrank.com or just hit me up on LinkedIn.
All right, Rob. Thank you so much. I learned a lot.
Thanks, Brian. Appreciate it.